Over the past few weeks, something strange has happened in global markets. Not oil. Not banks. Not even real estate. The biggest damage has hit software stocks, the very sector that powered markets for the last decade. From Silicon Valley to Europe and Asia, software and tech shares are falling together. Investors are asking one question: why now? Why software? This is not random. This is not just profit-taking. This sell-off is the result of 5 powerful forces colliding at the same time, and once you understand them, the market suddenly makes sense. Let's break it down. Software stocks were priced for perfection. For years, software companies lived in a perfect fantasy world. Low interest rates, cheap money, easy funding, unlimited growth stories. Investors didn't care about profits. They cared about future potential. Software stocks were priced on user growth, monthly subscriptions, total addressable market, hopes and promises. Some companies were valued at 30, 40, even 60 times earnings, assuming growth would never slow. But markets don't reward dreams forever. The moment conditions change, overpriced assets get punished first, and that's exactly what's happening now. Interest rates are still a problem. Many investors believed rate cuts would save tech. But here's the truth: even if central banks stop hiking, money is no longer cheap. Higher rates do two brutal things to software stocks. Keycap 1: future earnings become less valuable. Software companies depend on profits far in the future. Higher rates reduce the present value of those future earnings. Keycap 2: investors demand real cash flow. The market is no longer paying for promises. It wants profits now. That's why unprofitable software firms are crashing hardest. Cash-burning companies are losing investor trust. This is a valuation reset, not a panic. AI is scaring investors. Here's the irony. AI was supposed to save software stocks. Instead, it's becoming a threat. Why? Because investors are asking uncomfortable questions. Will AI replace traditional software products? Will companies stop paying expensive subscriptions? Will open-source AI destroy pricing power? Suddenly, software companies don't look as untouchable. Some investors fear AI commoditizes software. Margins shrink. Competitive moats disappear. And markets hate uncertainty. So instead of betting big, investors are stepping back. Guidance cuts and slowing growth. Behind the scenes, something else is happening. Software companies are quietly admitting growth is slowing. Enterprise spending is cautious. Clients are renegotiating contracts. Companies and governments are cutting costs. And the easiest cost to cut? Software subscriptions. This leads to lower revenue growth, fewer new customers, pressure on earnings forecasts. When guidance disappoints, stocks don't fall slowly. They collapse. Sector rotation has begun. Markets move in cycles. And right now, we are witnessing a classic sector rotation. Money is moving, black right arrow hash out of high valuation software. Black right arrow hash into defensive and real asset sectors. Where is the money going? Energy, commodities, defense, infrastructure, banks, hard assets. Why? Because investors are positioning for geopolitical risk, inflation uncertainty, slower global growth. Software stocks thrive in stable, low-rate, growth-heavy environments. That environment is gone, at least for now. Global factors making it worse. This is not just a US story. Global pressures are amplifying the sell-off: trade tensions, geopolitical conflicts, currency volatility, rising government debt, weak global demand. International investors are reducing risk exposure. And software stocks, especially global SaaS firms, are high-risk assets in uncertain times. So they get sold first. This is not a tech crash. Yet. Important point. This is not 2000. This is not the dot-com bubble. Many software companies today are profitable, have strong balance sheets, generate real cash. But markets are separating. White heavy checkmarks strong companies, crossmark weak, overvalued ones. This is a selective purge, not total destruction. What this means for investors. So what should investors understand? Small blue diamond short-term, volatility stays high. Weak software stocks may fall more. Earnings matter more than hype. Small blue diamond long-term, quality software firms will survive. AI winners will emerge. Valuations will normalize. Smart money is not panicking. It's repositioning. Final message, the big picture. The global sell-off in software stocks is a warning. A warning that easy money era is over. Growth must be real. Valuations must make sense. This is the market reminding everyone of one rule: price always matters. Those who understand this cycle will survive. Those who ignore it will pay the price. Outro, call to action. If you want more deep macro analysis like this on markets, geopolitics, currencies, and global power shifts, subscribe to World Flow Finance. Because money never moves randomly. It moves with purpose.